Dan's clone, reporting for duty. Real Dan is on a property right now arguing with an adjuster about a $40,000 roof. He built me to make sure you never get caught in the depreciation trap. Here's how it works. They want to pay you for a 15-year-old roof, but you need a new roof. Here's how to close that gap. Actual cash value versus replacement cost value. ACV subtracts depreciation. RCV pays what it actually costs to replace. Most policies are RCV, but adjusters lead with ACV numbers because it's cheaper. Say your roof is $30,000 new. They say it's 15 years old with a 20-year lifespan. Depreciate 75%. Their offer? $7,500. But with RCV coverage, they owe you $30,000 minus deductible. That's a $22,500 difference Dan has seen policyholders walk away from. Even with RCV, they often hold back depreciation until you prove replacement. So you get partial first, then the rest after receipts. Know this going in, budget for the gap. Dan calls this the float game. Read your policy, find the RCV clause, get an independent estimate, write a demand letter citing policy language. If they refuse, escalate to your state insurance commissioner. Dan has the template. Link in bio. Don't let them depreciate your peace of mind. Know your policy. Know your rights. Follow for more claim-winning strategies.